Most people think about tax planning once a year, usually right before April 15th. But if you're within 5 to 10 years of retirement or already in retirement, some of the most consequential tax decisions you'll ever make are happening right now. Here's why 2026 matters. The tax brackets just changed and not in the way most people expected. The rates that were originally set to expire at the end of 2025 were made permanent under legislation passed in 2025. The thresholds shifted upward with inflation, and for retirees, that combination creates a specific planning environment that's worth understanding clearly, because the decisions you make inside these brackets will determine how much of your retirement income you actually keep. Hi, I'm Scott O'Connell with Tactical Investment Advisors, and today we're going to walk through what the 2026 brackets actually look like, why they matter specifically for retirees, and what planning conversations are worth having right now. If you find this helpful, feel free to like, comment, and subscribe. Let's walk through it. First, what actually changed in 2026? Well, over the past several years, federal tax brackets have gone through significant changes and adjustments. For retirees, what matters most today is that the current bracket structure has stabilized and provides a clearer planning environment than many expected. Legislation passed in 2025 made the TCJA rates permanent. The 7 brackets remain 10%, 12, 22, 24, 32, 35, and 37. And for 2026, those brackets were adjusted upward for inflation. The standard deduction is now $32,200 for married couples filing jointly and $16,100 for single filers. Meaningful numbers for anyone managing retirement income. What this means practically: the tax environment retirees are planning is now stable and predictable. That's valuable, but stable doesn't mean simple, and it doesn't mean the planning work is done. For retirees with large pre-tax accounts, the bracket structure you're now locked into is a structure your required minimum distributions will be taxed inside for decades. Understanding that structure and positioning yourself deliberately inside it is where the real opportunity lies. Stable tax rules don't eliminate planning risk, they just make it easier to see whether your current strategy is aligned with them or not. Next, why these brackets hit retirees differently. Here's something many people don't fully appreciate until they're in retirement. Most of your income in retirement is going to be taxable. Social Security benefits up to 85% may be included in your taxable income, depending on your combined income. Traditional IRA and 401k withdrawals are taxed as ordinary income. Required minimum distributions, which begin at age 73 under current law, are fully taxable whether you need the money or not. Pension income is taxable. Certain investment income can trigger additional taxes on top of that. Layer all of that together, and many retirees find themselves pushed into the 22, 24, even 32% bracket. Not because their lifestyle is extravagant, but because their income sources all land in the same place at the same time. One thing most people don't realize is that your tax bracket in retirement isn't fixed. It moves depending on when you take income, how much you take, and what other sources are active at the same time. That movement is the planning opportunity, and if you're not actively managing it, you're likely paying more than you need to, year after year. If you want to see what your retirement tax picture actually looks like inside the 2026 brackets and where the opportunities are, click the link below to book a free consultation. We'll map it out together. Next, the Roth conversion window. For retirees and pre-retirees with substantial assets in traditional IRAs or 401ks, the years between retirement and age 73 before RMDs begin represent one of the most valuable planning windows available. When you retire, your income often drops significantly. If you're delaying Social Security to maximize your benefit, your taxable income during those early retirement years may be lower than it's been in decades. That gap between retirement and when RMDs begin is the window. A Roth conversion means moving a portion of your pre-tax retirement savings into a Roth IRA. You pay taxes on it now at today's permanent rates. From that point forward, that money grows tax-free, comes out tax-free, and is never subject to RMDs during your lifetime. If you retire at age 65 and RMDs begin at 73, That's an 8-year window where your income may be at its lowest point. Converting strategically during those years, filling your current bracket without pushing into the next one, can meaningfully reduce the pre-tax balance that will eventually force large taxable distributions, whether you want them or not. Done well, this approach can reduce your lifetime tax bill, giving your surviving spouse a better tax position and leave heirs a more tax-efficient inheritance. Done poorly or not at all, a large pre-tax IRA becomes a growing tax obligation that compounds with every passing year. Roth conversions are not the right move for everyone. The math depends on your current bracket, projected future income, timeline, estate goals, and other factors. But the window is real, and for the right person, it's worth acting on before RMDs close it. Next, the Medicare and Social Security connection. There's another piece of this that often gets overlooked, and it connects your income directly to your healthcare cost. If your modified adjusted gross income exceeds certain thresholds, Medicare Part B and Part D premiums increase. This is called IRMA, and it can add hundreds of dollars per month to your cost in retirement. Because Medicare calculates your premium based on income from 2 years prior, the impact can feel like it comes out of nowhere. When income rises from RMDs, conversions, or other sources, it can push you into a higher IRMA bracket 2 years later. So tax planning and healthcare cost planning in retirement are not separate conversations. They're the same conversations. Similarly, how you structure your retirement income affects how much of your Social Security benefit is subject to federal tax. Managing your combined income deliberately, using the 2026 bracket thresholds as your guide, may reduce the taxable portion of your benefit and meaningfully improve your net income picture over time. Next, what to do right now. 4 things worth evaluating with your advisor. First, know your 2026 bracket position. Understand exactly where your retirement income lands relative to the current thresholds and where it's headed once RMDs begin. Most people have never done this exercise clearly. It's often the most eye-opening conversation in a planning relationship. Second, evaluate the Roth conversion question for your situation. There's no universal answer. But if you have a large pre-tax balance and growing RMDs on the horizon, the math is worth running now, while the window is open. Third, look at your withdrawal sequence. Are you withdrawing from the right accounts at the right time? Are you coordinating Social Security timing with IRA withdrawals in a way that minimizes bracket exposure? These decisions compound across decades. And fourth, use the stability you now have. With permanent rates and known thresholds, you can build a retirement income strategy around a reliable framework and focus your energy on structure, timing, and coordination rather than guessing what Congress might do next. Here's the bottom line. The 2026 brackets are set. The rates are permanent. The thresholds are known. For retirees, that's not a reason to stop planning. It's a reason to plan with more precision than ever before. Your tax bill in retirement is not fixed. It's shaped year by year by the decisions you make about when and how you take income. The retirees who come out ahead aren't the ones who got lucky. They're the ones who understood the bracket structure they were working inside and made deliberate decisions within it. Good retirement outcomes come from planning, not guessing. If you're approaching retirement and want to make sure your plan is working for you, not against you, let's talk. Click the link in the description below to book a free consultation, and I'll walk you through your options. Thank you for watching, and if you found this helpful, feel free to like, comment, and subscribe.